What's up everyone, it's Scotty with MoneyVest. So in this video we are going to be talking about the bond market, and there's some really exciting and interesting stuff happening right now with the TMF absolutely going crazy on the day, up a little bit over 4%, up over 30% since I heavily went into it, and it's up over 50% from its lows. And we've talked about this TMF and TLT for months now, right? So we've been covering this on the channel. It's been part of our macro sort of tactical play for a very long time. And I want to break down exactly when everything happened, what was the main thesis around it, and what I'm planning to do. I did trim a little bit yesterday, took some profits off the table. I'm still green a little bit over 30% and holding on to the rest of my position, and we'll continue to monitor where the yields end up going. So the 10-year yields crack below 4%. Oof, TMF can be over 60 to as much as $70 per share. It also went through a reverse split recently, 10-to-1 reverse split that happened for TMF. So hope you all enjoyed this video, find it helpful. Make sure that you drop a like, and don't forget to subscribe to the channel if you're just joining us for the first time. I would really appreciate that. And link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the members only videos, Discord channels, and more specifically trade alerts. So if you do join, you will be able to access all the alerts here. So this was the alert from November 8th, pretty much going over with the 200 shares at $47.50. So I actually picked up 2,000 shares at $4.75, but because of the reverse split, it was actually 200 shares at $47.50. And of course, have been picking up more and more TMF along the way. So again, if you go back, you'll notice, again, picked up another 40 shares. Cost basis was $47.50. Added more TMF, 100 shares here, 100 shares there. So it just was continuing to build another 75 shares at $4.75. So I was consistently building that position. I also did mention in our Discord to be very, very careful. I think with levered ETFs, timing that trade is incredibly important, because if you get the entry wrong and you are underwater, let's say 20-30%, then it becomes incredibly difficult, right? Then you're just playing against the overall decay, and you want the price to move back up, so you break even before you even actually get in the green and become profitable. So it's really important to understand why I waited until I got the confirmation with the yields breaking down with a very, very important support level before going in a lot more heavier in the beginning of November. So this right here is where we are. TMF, take a look at this. Two very solid back-to-back green days. It's up another 4.5%, just a little bit under $60. Yesterday, it was up another 6%. And of course, the last few days, in fact, on the week, if you come over here, it is up a whopping 10%. Last week, it was up another 11%. The week before that was basically flat. The week before that, up another 7%. But close to from October 23rd, it is up nicely 56% as the yields continue to show signs of weakness. And guess what? We're coming down to 4%. We're coming down to just low fours here on the 10 years. And this right here was the breakdown that we were talking about with that negative divergence as well. Now, in case we see a breakdown below 4%, the interesting thing is that there is going to be more and more potential panic buying in the market, something that I've mentioned before, because look, we knew that this was going to happen, right? I mentioned this in our previous market updates and videos that it's not a question of if, it's a question of when, because yields have not been as high as they are at over 5% in over 16 years. So if you're a fixed income trader, if you're a bond trader, right, watching this video, or if you're a capital allocator, institutional investor, you've not seen these rates in your 16 years of investing career, right? So if your goal is to beat inflation, if your goal is to simply stay on par with inflation, inflation's at 3.23%, and you're getting a 4+% rate of return over a 10-year time period, of course you're going to take advantage of it, right? You're not trying to generate alpha. You're not a hedge fund, right? You're not trying to generate an alpha and beat the market. Instead, you're simply trying to beat inflation. And when that happens, there's a level of panic buying, because once the yields start dropping, right, investors are going to be more excited and more motivated to lock in these rates. And when they do that, what do? They buy bonds. And when prices go up, as they're buying bonds because the demand is high, yields continue to come down because of that inverse correlation between prices and yields. And that's exactly what we are seeing. We still do know that the Treasury Department, the Fiscal Department is actually going to be issuing close to 1.4, 1.5 trillion worth of debt over the next couple of quarters. So that again is going to be a little bit of that supply factor that's going to play a bit of a role. But on the other hand, you've got hedge funds and net shorts covering their positions, and at the same time, you're seeing, money market funds sort of exploding with $6 trillion of assets under management. In other words, the money that's sitting on the sidelines is going to start moving into fixed income, which is why they want to take advantage of these higher, longer dated yields. And specifically when I say longer dated is because if you come over to the yields, it's only the longer dated, long duration bonds that have actually moved down. So if you take a look at over here, the original three, the divergence has gotten worse because if you take a look at these three over here, these are going to be 6 month and 3 month and 1 year. That's it. That's short duration. That's a shorter end of the curve. Versus if you take a look at these ones over here, these are the longer end of the curve, right? So what does that tell us? Okay, that simply tells us that investors, capital allocators more specifically, are now a little bit uncertain that these yields are not going to be there for long, right? So they want to lock in these yields for the 10-year, the 20-year, the 30-year, even the 5 and the 7 years, and they want to be locked in. Because if investors were kind of uncertain that rates were going to go higher on the longer end of the curve, and we're going to see, 5+%, 5.5+%, and they just needed some place to park the money in the meantime, what would have happened? The demand for these longer end of the curve yields would have not been there, right? So investors would not have been buying these. They would have instead been buying these, and that would have drove the shorter end of the curve, shorter end of the yields, in other words, 3 months, 6 months, 1 year, lower, and that would have uninverted the yield curve. But instead, what we are seeing is the inversion of the yield curve even more. So this right here is, once again, we're going back into the negative territory, as this is now once again negative 127 basis points, and this right here is also negative 48 basis points. So in other words, we are seeing the inversion of the yield curve even more, but that's happening on the back of the longer end of the curve dropping farther, faster, with the short end of the curve, which is 3 months, 6 months, 1 year, staying where it is. So that's actually quite an interesting sort of shift in the market. And of course, we see the yields continue to drop further. And as we already know, the market's pricing in 5 rate cuts going into 2024. They're kind of calling out the Federal Reserve's bluff, Jerome Powell's bluff, and they don't believe that he is actually going to keep rates steady as high as they are. And they also don't believe that they are going to raise rates anymore. So that's where we are. TMF continues to charge higher. Now, my levels that I'm watching, ideally, it was at these levels. I mentioned $6, right? That's $60, and that's exactly where we are. 59.81 is the high for the day. Previous resistance potentially acting as a new resistance, and TLT here also coming up to that resistance of $96. So it's also seen a very nice rally of over 17-18%. So this right here is going to be that resistance. Ideally, I mean, that's a level that I would be looking to trim a little bit. We are very overbought right now from an RSI MACD standpoint, but in case we see a breakdown below 4, right? So let me just put them side by side. So if we see the 10-year yield break down below 4%, then I think it's possible that TLT breaks above 96 and TMF breaks above 60. So this right here, very, very important level at 4%. And that's really what I'm watching now going into the next couple of days. We've got the unemployment numbers coming out later this week, but this is going to be a very, very important level of support here for the 10-year yields, and TLT also approaching that resistance at close to $96, $97 per share. So again, that's the inverse correlation between these two. And if you do get a little bit of a bounce, I'll be looking to trim some of my position once again. I know this trade was a macro tactical play going into 2024, but it's now starting to move very, very nicely in our favor, something that we have waited for a very long time. So hopefully you are doing really well with this trade. Congratulations if you are in the green with this. Cannot be more happier. Again, hope you guys enjoyed this video. Let me know in the comment section below, what do you think about TLT and TMF? As always, if you enjoyed it, found it helpful, make sure that you drop a like. Also, do check out the links down below. You can access all these trade alerts, trade ideas. Everything's going to be included with the link down below. And as always, happy investing. I'll see you all in the next video.